Thank you. Thank you for having me here today. And at S&P Global, we have just changed our. We have just released a proposal to change our methodology to analyze covered bonds, and the last review of our covered bond methodology occurred in 2014. Thank you. And we have now published a proposal for further changes. There is a comment period that runs to May the 23rd of May, and you can see here how to provide comments. We are generally interested to hear the feedback from market participants on what we are proposing to change. As I said, the last review of our methodology occurred in 2014 when in Europe we adopted the Bank Resolution Recovery Directive. We introduced at the time new steps in our framework, including the resolution regime analysis and including the jurisdictional support analysis. The changes that we are proposing today do not modify the overall framework. The structure remains the same, but we are proposing to review some of the assumptions that we make with each component of our analysis, in particular what we call the jurisdiction support analysis and the collateral support analysis. Why we are changing? In the last 10-11 years, we have a few changes in the regulatory and legislative framework for covered bonds that affect our analysis. Think about the EU Harmonization Directive. We have some changes in the markets, including an increased central bank intervention. Also, we have some period of market stress in the aftermath of the sovereign debt crisis, more recently with the COVID. And this period of market stress allows us to better calibrate our credit assumption. The impacts on covered bonds in terms of overall ratings is expected to be limited if the proposal are accepted. We expect only one program to be upgraded by one notch. However, there will be a more significant impact on the over-collateralization required to achieve the rating at the stand. We expect this over-collateralization level to be reduced and average by 5% for the program that we rate, and also to be more stable over time. So, as I mentioned, the overall framework remains the same, so the starting point is still the issuer credit rating as it must be. The first step where we assign additional notches above the issuer credit rating that we call resolution regime analysis is also unchanged. What we change is something on what we call the jurisdictional support analysis. That is our assessment of the likelihood that a covered bond issuer that is in trouble may receive some form of external support from actors such as the local government, regulator, the central bank. In this case, for a highly rated issuer in jurisdiction where covered bond is a systemically important product, we expect that the legal minimum level of over-collateralization will be sufficient to reach the AAA. And this proposed change is to reflect a number of things that have occurred in the last 10 years, including the fact that with the Harmonization Directive, covered bond pool tend to be homogeneous, and also the protection that is granted to investor in terms of liquidity protection, minimum over-collateralization are more homogeneous. So to a large extent, again, for a highly rated issuer in well-established covered bond jurisdiction, the legal minimum will be sufficient to reach the AAA rating. Also, currently, we do not assign a jurisdictional support uplift above the sovereign rating on the assumption that the sovereign will be the main source of this potential support. We still believe that this is the case, but we have observed that in instances such as for countries that are part of a monetary union, support may be also received from a central bank that is, which have a creditworthiness that is higher than some of the countries that are part of the monetary union. And so we want to give at least partial credit to this. We have observed instances that where this central bank support have been received. And therefore, we propose to assign up to one additional notch above the sovereign rating for programs in countries that are part of a monetary union. And in terms of collateral support for the great majority of the program, those that are not conditional pass-through, we still propose to assign 4 notches of so-called collateral-based uplift. But to review some of the assumptions about the required credit enhancement to assign these 4 notches. When we analyze a collateral uplift, we look at 2 key components, the so-called credit risk. We look at the characteristic of the pool and the amount of losses that may occur in a stressful environment. And this analysis is very much aligned with what we would do for RMBS. It's a credit risk analysis. And then the other components is a refinance risk analysis that is more specific to covered bonds. And refinance risk is obviously in a situation where covered pool administrator need to repay covered bond that is maturing, say, in 6 months with assets that have a much longer maturity date. In this instance, and especially in a time of crisis, we expect that the pool administrator will be able to liquidate assets at a discount with an haircut. And therefore, this haircut will means a higher over-collateralization when it comes to assign a certain level of rating. We plan to simplify certain assumption compared, for example, to a structured finance transaction in terms of what we do with the likes of basis risk, of spread compression, but also importantly, what we are proposing to do is to assign the first 2 notches of out of 4 of this collateral-based uplift based on the coverage of credit risk only. So again, this means that for some highly rated issuer that only need 2 notches of collateral-based uplift to reach the AAA, the required credit enhancement will be lower. But also, we propose to change some of the assumption that we make the second part of our analysis, the analysis that look at refinancing risk, refinancing cost. Currently, what we do is in order to calculate the haircut that we assume for the liquidation of the asset, we discount future cash flow, the expected future cash flow from the cover pool. And the amount of the discount, the haircut, is a function of, among other things, the discount rates that we apply. The discount rates, so now we call in our methodology the target asset spread are derived from what we have observed in market, currently mainly on RMBS, on the assumption that the insolvency administrator will liquidate the asset by repackaging them in an RMBS. So the proposal is to lower in many instances these target asset spreads to reflect the fact that most probably the most likely source of refinancings will be another covered bond issuer rather than an RMBS, and covered bonds tend to be cheaper than RMBS, especially at time of crisis, but also to consider other market changes that we observed in the past 10 years or so, including a more aggressive central bank intervention at time of crisis. So for these are the new proposed target asset spread, again, that our refinancing cost assumption. You see that in most instances they will be lower, and this will result in a lower haircut, a lower over-collateralization to achieve the current rating level. The other thing that we are proposing to change is that instead of applying this target asset spread, this very conservative refinancing assumption throughout the life of the transaction, the covered bond program. We apply only for the first 3 years of this of the transaction, where we expect the crisis to happen, when we expect to be more challenging to refinance assets. And to conclude, we are changing some of the assumptions regarding counterparty risk analysis. So in the first part of our rating approach, we look at how many notches we can assign above the issuer credit rating with the resolution regime analysis, the jurisdictional support analysis, and collateral support analysis. Before we assign the final covered bond rating, we see if there are limiting factors to the final rating, other risks that may lead us to assign a lower final rating. One of these is sovereign default risk analysis that is not changed. The other is the counterparty risk analysis. The risk that counterparty, that are entities that may hold money for the covered bond issuer or make payments to the covered bond issuer, are unable to perform on their obligation. And here again, we are proposing to simplify our approach and to give more credit to the ability of the issuer to manage counterparty risk in a way that is not possible, for example, for a structured finance issuer. And this will mean that the requirement for highly rated issuer are less stringent than compared, for example, to an RMBS issuer. And with that, I try to be brief, and I'll be around today and tomorrow if you have a question. But again, we strongly encourage you to consider these changes and to provide comments if you have any. I think these slides will be available. Thank you very much.